In this video, I'll cover everything you need to know about home equity, including how to calculate it, how to use it to get a better rate, and all the ways you can access it. Firstly, let's define what home equity is. Home equity is the amount of money that is available in your home. In simple terms, it's the difference between the current value of your home and how much you owe on it. What does equity in your home mean? Well, it actually means different things to different people. When you're selling your home, equity refers to the money that you'll have left over once you've sold your home. So if you had a home that sold for, say, $500,000 with a loan of, say, $400,000, then the equity would be $100,000. To the bank, equity would refer to something completely different. And it's the difference between the bank's safety lending margin, known as loan-to-value ratio, and how much the bank could lend to you, say a maximum of 90%. It would mean in the same scenario that you would only have $50,000 in equity available. To calculate your home equity, you could either use our website here or multiply the bank's lending margin by the value of your home minus the loans currently outstanding. The amount of equity in your home is primarily influenced by the bank's valuation. The higher this is, the greater the amount of equity which is available. Over time, equity tends to grow due to two factors. Firstly, properties generally appreciate in value over time. And secondly, as you make principal and interest repayments, your debt will gradually decrease. This means that if you start with a small deposit, borrowing say 90%, your equity could increase over a certain period of time, resulting in a lower loan-to-value ratio than when you originally applied for your home loan. This is significant because many banks offer a lower interest rate for a lower LVR loan. Here are 7 easy ways you can increase your equity position. 1. Obtain multiple bank valuations. We already know that the most important factor to your equity position comes in the way of a bank valuation. So don't just rely on one bank valuation. Get a second or even a third opinion, as can help you better understand the value of your property and potentially uncover some discrepancies. In some cases, we've seen a difference of more than $130,000 between valuations. 2. Increase your initial deposit. While this is not always feasible, putting down a larger deposit can instantly boost your home equity and potentially reduce your loan repayments and the rates on offer by the banks. 3. Opt for a shorter loan term. By choosing a shorter loan term, you'll not only pay off your loan faster, but will also accumulate equity rapidly. 4. Invest in property improvements. You can look at a basic renovation like a coat of paint or a bigger one like adding additional rooms. Bank valuers are really driven by the numbers, and it's really important to understand this. They're looking at things like your number of bedrooms, bathrooms, and car spaces. So if you're looking to influence the bank valuation, you really want to focus on these aspects and put your money and energy into this, as will help increase the value of your home. 5. Making additional repayments. Making extra repayments on your mortgage each month will help you swiftly decrease your loan balance and build your equity more rapidly. An interesting tip to consider is making half monthly repayments each fortnight, which will reduce your loan term by as much as 5 years, as you'll be paying 13 months home loan repayments instead of 12 each year. 6. Use any additional funds you receive from, say, a tax return or bonus to make an additional repayment on your mortgage, as it'll help reduce the balance. And 7. Live on one income. If you've purchased a property with a partner, consider living on one of your incomes while using the others to make additional repayments on your mortgage. This can significantly reduce your loan balance and increase the equity you have over time. To purchase a home with no deposit, you can use equity. Let's start by calculating the amount of money you'll need to contribute, including your deposit and all the associated costs, based on an 80% loan-to-value ratio. So, as an example, if you plan to buy an investment property in Brisbane, you'll need about $120,000 for your 20% deposit plus additional costs. Next, let's quickly calculate the equity you have in your current home. Looking at our example, you can see that we have a loan-to-value ratio of 50% and have access to a huge amount of equity. Now, using the equity available in your home, you could purchase another property without a deposit and fund all the associated expenses. In this example shown, you can see your loan to value ratio would increase to 62% on your home, enabling you to avoid mortgage insurance on both your purchase and your current home. Thanks to your equity position in your current home, you could fund the entire purchase, including associated costs, ultimately enabling you to buy an investment property with no deposit down. This same process can be followed to release equity for a variety of reasons, from renovating your home to consolidating high interest debt, or even financing your wedding. When accessing equity from your home, it's important to remember that lenders typically provide home loan terms over 30 years. Therefore, if you plan to consolidate, say, a car loan, consider creating a separate split on your home loan to maintain the same loan term for your debts you're consolidating. And in this way, you'll receive the full benefit of using your equity without incurring additional costs by paying it off over a longer period. And if you're looking for a great mortgage broker, here at Hunter Galloway, we can help. We service Australia-wide and don't charge a fee for our service. So reach out and contact us online at huntergalloway.com.au or call us on 1300 088 065. Thanks for watching, and until next time, I'll catch you then.